The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone, and welcome to today's Credit Intel F&D Reports Retail Outlook 2023 webinar. On the call today, this is Michael Blackburn. We also have Al First, Robert Marzo, Taylor Ricketts, Jim Rice, Alan Lee, and Greg Katz. So we're going to be all talking throughout the call with different inputs on different sectors and retail trends and our outlook for the upcoming year. Before we get into the specific retail sector side, we wanted to start off with just a general overview of macroeconomic trends. So looking at the main economic stories for 2022, this shouldn't be a surprise, but those key stories were high inflation, stronger than expected consumer spending, and the tight labor market. So to fight the lingering inflation, the Fed reversed course, perhaps too late, and adopted an aggressive tightening policy to slow growth and pricing, which in turn is expected to slow consumer spending. The key for the Fed will be to try to create what is the so-called soft landing, slowing growth with minimum job cuts and thereby avoiding a deep recession and deep job losses. So despite a decent end to 2022, consumers and retail are bracing for a very challenging year in 2023. The U.S. ended 2022 with fourth quarter gross domestic product, the sum of all goods and services produced by the country. GDP cooled slightly. It increased 2.9% in 4Q. That was down from 3.2% in the third quarter and 5.7% in fourth quarter of 2021. Consumer spending, which is spending on all things, including retail and services, that's the largest contributor to gross domestic product, representing about 2/3 of GDP. So we're obviously a consumer or consumption-oriented economy. Consumer spending grew 2.1% in the 4Q, but that was weaker than the previous period. Offsetting that growth in the fourth quarter, we saw a sharp slide in housing spending. That was down 27%, and exports were also down slightly. On the other hand, boosts in government spending and private business investment, notably inventory, aided growth. Having a slight problem right now with a technical problem, so I'm just going to pause for a second here. Bear with me a moment. Just bear with me one second. Having some technical difficulties on my computer. Should get this up and working in a second.
Taylor, can you juggle for a minute?
Yeah. Can you hear me? Hey, Mike, can you hear me?
The slide's not changing, Mike, or are you?
Like,
All right, I think I fixed that problem. Sorry about that, folks. My computer just crashed for some reason, but I think I got it back up and running. All right, so where was I? Gross domestic product. So for the year, GDP grew at an annual rate of 2.1%. That's down from the 5.9% growth that we saw in 2021. And that's real growth after inflation. If you look at it on a nominal basis, we saw a pretty strong growth of 9.2% for the year. So that is an implied inflation rate of about 7.1%. So although consumer spending grew overall in the fourth quarter, parts of the economy showed signs of cooling. Notably, retail sales fell the last 2 months at the sharpest pace of 2022. Existing home sales fell for the 11th straight month, and hiring and wage growth eased. Shoppers reined in spending on home electronics, furniture, clothing, and other after stacking up on those goods earlier in the pandemic. In addition, we had the stress on consumer budgets from higher cost food and other essentials. As 2023 gets underway, recent surveys of U.S. purchasing managers found that higher interest rates and the persistent inflation is weighing on demand in January in the manufacturing and service sectors. Still, with fourth quarter gross domestic product coming in stronger than expected, there's been less pessimism for the outlook for 2023 in the last week or two. And that's not just for the U.S., but also globally, as Europe saw better growth in fourth quarter. And China now is reopening. It abandoned its zero COVID policy. So we expect more growth from that economy as well. So inflation is the primary economic issue. Inflation started to spike in 2021 and was initially due to supply shocks and shifts in consumer demand for goods fueled by government stimulus, which the Fed and many economists thought coming into 2022 was a temporary issue. But then in 2022, we had the continued supply issues with commodities, the war in Ukraine. Both those factors complicated things in 2022, and inflation proved stubbornly sticky. Inflation, as measured by the headline number, which is the consumer price index, has eased in recent months. It dropped to 6.5% in December, down from a peak of 9.1% earlier in 22. But the costs of many essentials, namely groceries, remain elevated. Grocery prices are still up over 10% year over year. Energy costs have also come down, but could ramp up again as China fully reopens. Many refineries are also planning a turnaround or shut down for maintenance. And we also have Russia, which appears to be digging in for a long war in Ukraine, so that could interrupt or disrupt commodity prices in 2023. Thankfully, a warmer than expected winter in Europe has led to less energy demand in that continent. So the Fed says it watches this headline CPI number, but it actually pays closer attention to the core personal consumption expenditure price index. That's a better long-term indicator on where inflation is headed because it strips out prices that can be more volatile over short-term periods. The latest personal consumption expenditure index data shows inflation is also falling. It fell down to 5% in December from 5.5% in November, but it's still too high. And we remember that the Fed's target is a 2% inflation rate. The latest data also shows the continued shifting of inflation pressures from goods to services. On an annual basis, goods inflation rose 4.6% in December. That's down from 6.1% in November. Meanwhile, service inflation held steady at 5.2%. Goods inflation peaked in June of 2022 at 10.6%, while services inflation bottomed at 4.7% in July. Another thing we're seeing is a shift in inflation from more volatile commodity-driven categories like meat and produce in grocery stores and energy to more sticky categories that typically decline after they increase, like rising rents. So you're seeing more things that don't tend to decline after they increase, like rents And if you look at even in grocery stores, you're seeing more center store inflation rather than the more volatile perimeter items. And of course, we all know how the price of eggs has risen recently. Looking ahead, there remain a lot of potential issues that could pressure prices, including China reopening, lingering trade wars, particularly in technology. We have land wars, we have infrastructure costs related to climate change, and more closely to retail, the unwinding of the last 40 years of globalization with more companies nearshoring of supply chains. As an example, the McKinsey survey found that 75% of sporting goods companies plan to expand nearshoring activity by 2025, and 8% are already doing so. So to combat inflation, and after decades of easy money policy, the Federal Reserve quickly reversed course in 2022 and pushed the Fed funds rate up from near zero to mid 4% range. At a meeting later this week, we expect another 25 basis point hike. So the key for the Fed, again, is to curb growth just enough without destroying too many jobs and pushing the economy into a deep recession. While it takes many quarters for the impact of rate tightening to hit, if growth slows abruptly, we may also see the Fed abruptly reverse course and start to lower rates. Right now, it seems the Fed is taking a less aggressive slant, but further hikes of Fed funds rate to the 5% range is expected, which would put the prime borrowing rate, which is built off of the Fed fund rate, at around 8%. And the prime rate at the beginning of 2022 was just 3.25%. U.S. Treasury rates are also on the rise, as are credit spreads, or the difference between the different corporate issue rates when companies issue bonds and the so-called risk-free government rate. So that spread accounts for the risk of default of the corporation issuing the debt. These spreads are up depending on the credit quality of the issuer, but historically only back to historical averages. So they are up sharply, but back to where they are historically on an average basis. Still, with earnings pressured, spreads could widen further. The increase in spreads reflects the expectation of more debt defaults. And just kind of looking at, say, an investment grade company and how that's impacted their cost of borrowing as well as more risky accounts, you can take a look at Kroger's bonds, which at the beginning of 2022, they were yielding around 1.5%. And those bonds, let's say a 5-year bond, is now yielding mid 4%. So the yield on that bond went up 3% over the last year. For the consumer, we have mortgage rates, which are more closely tied to long-term treasury rates. In 2022, we saw a lot of volatility. We saw the 30-year mortgage rate jump from historical lows to a 20-year high in a matter of months. The one thing, though, helping the housing market has been a relative dearth of new home construction and limited inventory. Most spending has been focused on multifamily housing since the Great Recession of 2008 and 2009. Another thing that is already starting to rattle the fixed income markets is a stalemate with the federal debt ceiling. Goldman Sachs recently commented that the debt limit now is a greater risk than at any time since 1995 or 2011, when a government shutdown, or we came close to shutting down the government to avoid missing payments. So right now, Washington has until a June deadline to act on raising that debt ceiling. As for the recession risk, if we look at the Treasury yield curve, we currently have an inverted yield curve, and that's a good predictor historically of when a recession is imminent. What that means is that short-term bond yields are higher than long-term bond yields, and you can see that in the blue line here on the bottom left. With long-term rates lower, investors have concerns about the future, so that they expect rates to ultimately come down, while the higher short-term rates mean we expect the Fed to keep rates higher in the short term, possibly into 2024. So combined, all these risks, and we look at last year's bankruptcy slowdown, that could set the stage for an uptick in defaults in the month ahead. So after a quiet year in 2022, defaults and bankruptcies are expected to rise. We've already seen Party City go under, and Bed Bath & Beyond could follow soon. So looking at the labor market, the unemployment rate edged down to 3.5% in December, and it's remained in a narrow range of 3.5 to 3.7% since March, so very low unemployment. Labor participation has also improved, but it remains about 1% below the February 2020 level. The number of people who are in the labor market is down to 62.3%. There are many who have left the labor market for various reasons, whether it was early retirement, moving from 2 to 1 income families, temporary leaves of absences, especially among young workers. You also have more gig workers who may be excluded from the data as well. Heretofore, the labor issues have centered around understaffing, especially in food service and retail, and the rising hourly rates. The latest data still shows a large labor gap, meaning we have over 10 million openings with about 6.5 or just over 6 million of unemployed people. So we have just under 2 jobs for every active job seeker. So there are plenty of jobs still out there. Separation rates also remain high. Still, recently we have begun to see layoffs extend beyond the technology sector into retail, and especially among e-commerce operators, apparel retailers, and houseware companies. Hudson Bay e-com operations recently announced layoffs. Stitch Fix announced layoffs. Wayfair announced layoffs, as an example. One interesting point is that the small companies have been responsible for all the net job growth in the U.S. since the onset of the pandemic, and account for almost 4 out of 5 available current job openings. This is according to investment company Jefferies. And then if you look at the Small Business Administration data, small businesses generated about 2 out of every 3 jobs over the past 25 years. So that's really the vehicle of growth in the job market right now. Now, looking at some of the surveys with small businesses, optimism is falling. And one way we can gauge what's going on in this sector is temporary worker staffing has fallen for 5 straight months. So that usually precedes a recession when we see fewer and fewer temporary jobs out there. As for wages, median weekly earnings have started to dip lower, about 6% higher year over year at the end of 2022. There's lots of different ways of looking at wages and the economic data. Another piece of data from the Labor Department is an employment cost index, and that showed a 5.1% increase in fourth quarter year over year. Meanwhile, when we look at inflation, it was around 7% last year. It dropped to 6.5% in December, but regardless, real wage growth after inflation is negative. While the labor market remains tight, both wage gains and inflation have begun to cool, and previously, as I noted, along with the cooling of consumer spending. So another thing that we saw during the pandemic that was an interesting point was there was some evidence of the shrinking inequality gap. In the decades before the pandemic, wages of lower paid, less skilled hourly employees steadily lost ground to those of skilled workers. In the 2 years since the pandemic, those trends have sharply reversed. Since February 2020, average hourly earnings are up 15%, but for production and non-supervisory employees, they are up 17%. So basically what that means is managers have lost ground. So looking at the consumer, one of the biggest factors that fueled the strong consumer spending the last 2+ years was the buildup in savings. At its peak, Americans built up $2.3 trillion in excess savings during the pandemic, but that's starting to come down. Economists estimate about half of it is spent. The savings rate has come way back down from its peak of 34% in April 2020, and even 7.5% a year ago. It's now down about 3%. It's been trending in that range. It was up slightly in December to 3.4, but as the chart in the bottom right shows, it's still well below historical averages. Consumer sentiment was also up slightly in December, but that also remains below historical averages. And also a survey of consumers show that about 2/3 expect a recession in 2023. If we aren't, arguably half the population is already in a recession, given where inflation is. So with these strong economic headwinds, we have seen more bifurcation among consumers between consumables and discretionary spending, with grocery and drug spending still strong, while sporting goods, houseware, apparel, and electronics slipping, and also between low middle-income consumers and higher-income consumers, which to date have supported luxury brands. Also hurting many discretionary categories like electronics and home goods was a pull forward of demand in 2020 and 2021. And we now have more consumers shifting spending back to services. As a result, retail good companies are facing a slower growth outlook, while higher income people continue to spend, particularly on services like travel. But here, too, we're starting to see some cracks. Luxury is not completely immune from recession, but usually sees a longer lag time before it's felt. Recently, Nordstrom said that sales for the holiday period decreased 3.5%. Macy's also said holiday sales were lower than expected, and they're having a very cautious view of 2023. So signaling, I thought this chart in the middle here was also a little interesting in terms of some conflicting messages in terms of the data. These two charts show elevated savings levels among all consumers, yet the other chart shows an increase in households having difficulty paying bills, including over 20% who earn over $100,000 and about 10% who earn $200,000. So all this would seem to imply U.S. households have trouble budgeting. So given that trend, it's not surprising to see consumer indebtedness rising. Another sign some households are running low on savings. According to the New York Fed, total household debt increased 2% to $351 billion in the third quarter. It was the largest increase since 2007. One particular factor that was was the ballooning of credit card balances, which through the third quarter, and most reports seem to indicate that credit card balances continue to rise during the holiday period. So debt is on the rise. Delinquencies right now are starting to increase, but they remain historically low. One of the things that's contributing to that has been the deferral in student loan payments. That's currently, the Biden forgiveness plan is currently being challenged in courts. But once that is resolved, we do expect the student loans to start to be repaid. So looking forward, 2022 may prove to be a revelatory year for the future of the economy and retail. The questions are, how much monetary tightening is needed to curb inflation? How deep will job losses in a recession be? How big an impact will deglobalization, climate change, and clean energy transitions have? And where will interest rates settle, and how will the consumer react to these challenges? Within retail, companies are taking a more conservative tack with focus on preserving capital. They're bringing inventory orders down, and we're seeing more layoffs. A weaker economy and consumer spending will be particularly hard on e-commerce companies who need the growth and scale to leverage their higher operating costs and investments. Recently, dot-com companies like Stitch Fix, Wayfair, and e-commerce units of Hudson Bay have all recently announced layoffs as they focus less on growth and more on controlling costs to maintain liquidity. So the one thing seems sure is that we're in for more change, and the post-COVID world will offer up a new set of challenges. With that, I'm going to turn the call over to Greg Katz, who's going to talk about some recent retail trends.
Thank you, Mike. Appreciate it. So I'm going to talk real quickly about the overall retail trends for 2023. I think it's summed up with the phrase, the harmonization of digital and physical retail. As this trend has been ongoing. It didn't start recently. It's probably been even before COVID hit. And harmonization is about the customer and the customer being the channel. And so instead of this omni-channel approach that everyone is talking about or has been talking about over the years, this is different. So instead of having a presence in all channels, this is about being everywhere the customer is and everywhere the customer wants you to be as a retailer. So think of it as this way. The services and the products are the physical location. The convenience is the digital component or the technology around even the physical experience. And then there's the human interaction and the experience around that, or experiential, as you've heard it called. And all of these are customer touch points. And so all of this impacts the other trends that are listed here on this slide. The next one being returns. And returns. The National Retail Federation says that returns are about 21% of purchases in 2021. And that equates to about $761 billion. And there's even other data that shows that customers return about 40% of what they buy online. And so the return process, it's expensive. It varies widely and can be confusing from a customer perspective, but most importantly, it's ultra competitive and therefore costly. So all in all, the goal is to reduce friction, keep customers happy, and that creates more competition, more costs, et cetera. Retailers lose approximately 1/3 of their revenue to returns. So you're starting to see companies experiment in different ways to handle returns and kind of take control back. And that includes kind of the new school version of restocking fees. Companies like Zara and H&M are starting to look at charging for returns and finding out ways to kind of recoup some of that cost and put some of it back on the consumer so that they can start looking at maintaining margins, maintaining profitability. There's also the environmental component to consider, which is, you're seeing a lot of companies partner with places to return, FedEx stores and Happy Returns and some of the other scenarios like that. Another trend is, I call it, at some point it has to be about profitability. I think we've all started to ask the question, can e-commerce in and of itself be run profitably? And that question's yet to be answered with consistent long-term profitability from a retailer. You look at returns, you look at exchanges, you look at the delivery and how, we've pushed towards even, 1 hour delivery, 30-minute delivery, definitely same day, 2-day delivery. And so a lot of the buzz around profitability is starting to really take a look at these e-commerce companies and realize that there's got to be more than marketing buzz. There's got to be substance. There's got to be this path to profitability. And the marketing buzz is allowing, I guess it's creating a shorter and shorter runway for retailers to deliver, especially in the digital realm. Another trend that's out there and will be very prevalent in 23 is retail media. Retail media will continue to surge, but the proof of concept will have to be analyzed at some point and determine what the true ROI is. For those of you who aren't familiar with retail media is marketing to consumers at or near their point of purchase, or at a competitive choice point when you're deciding, between products, between competitive retailers. This can be in store, it can be online, it can be through loyalty programs. Think of it as like a digital shelf, and it's got very big visibility, and it's kind of in your face, and it's very targeted exposure. So it helps brands advertise right at their customers where they are, and not necessarily advertising in mass. Another trend is going to be experiential or differential versus ordinary. As was mentioned earlier by Mike, there's a lot of margin pressures. And so to combat labor, especially labor and other margin pressure, to create these harmonized experiences, you've got to kind of take a couple of different paths. You've either got to be very, very good at being ordinary, or you've got to create experiential differentiators. And those two things are really competing against each other for places in the marketplace as we continue to move into 2023. And finally, resale. The resale market, the secondhand market, is expected to double by 2026 into an $82 billion industry. In 2021 alone, it grew by 32%. And 41% of consumers today say that they shop for apparel. When they do, the secondhand is the first place they try and look. And that 41% goes up to 62% if you look at just Gen Z and millennials. So given the fact that on average consumers wear less than half of their closet on any kind of regular basis, and the move towards sustainability, you're seeing a lot of concepts start to look at this resale market as the way to go, especially in the top categories like casual wear, outerwear, accessories, and footwear. So those are the top trends as we see it going into the rest of 2023 and beyond. And with that, I'll turn it back over to Mike.
Thanks, Greg. So we did have one question I wanted to get to quickly regarding supply chain and the backlog of ships, cargo ships off the coast. For the most part, that's been normalized. Shipping rates are way back down to, below where they were a year ago, but they're still slightly elevated. But for the most part, those issues have normalized.
Okay, these next two slides here kind of show a cross-section of performance of the major retail segments over a 6-year trend. So it's important because trends from 2017 to 2019, you can see are much more normalized. And then we have the volatility hit in 2020 with COVID, in 21 with the recovery, with stimulus, with supply chain, and then the inflation impact on 22. The same thing with the second slide, which shows EBITDA margin. And you can kind of see each segment may have its own cadence, when or if they experienced increases or decreases in performance. And overall, this just kind of shows that certain segments, margins might be higher now than they were before. And looking at 23, I think costs remain elevated. Consumers are starting to cut back a bit, and maybe the pendulum is starting to swing the other way in certain segments in particular. That's what we're going to discuss in the next half hour.
Right. So starting off with the retail drug sector, obviously an essential category, and top line growth has been still pretty good. We saw the expected rebound in acute scripts as consumers return to doctors' offices. This was more than offset by the COVID headwinds, particularly on the margin side. We saw declining vaccinations and testing, and that hurt them on a profit margin perspective. Front-end sales performance was largely improved. Another thing hitting the margin, though, was shrink, particularly elevated theft levels in drugstores, and that's only now beginning to normalize. The other big thing last year was Walgreens and CVS, as well as Walmart. They all announced approximately $6 billion state and local government opioid settlements. And that will hopefully put the opioid issue in the rearview mirror and make those payments over the next 10 to 15 years. Although there is still potential for further litigation. The sector overall still faces the ongoing headwinds from reduced pharmacy reimbursement rates, increasing front-end and now more pharmacy online competition. Notably, Amazon has been very aggressive going into the pharmacy space, and even Mark Cuban, the entrepreneur, has been he launched his Cost Plus drug program and recently acquired another business. So he's been very aggressively going into the pharmacy space as well. Initially, this is just impacting the cash-paying customers, not the insured or Medicare or Medicaid customers. That's less than 10% of drug scripts, although that obviously could change in future periods. So given these factors, store rationalization is occurring among the big three, and that's going to continue in 2023. The bigger story was the continued shifts by Walgreens and CVS into primary care. So this transition away from their traditional brick and mortar retail into being more diversified healthcare companies, that obviously adds a level of complexity and risk to the overall sector, including the increased leverage related to major acquisitions that they've completed. Meanwhile, the smaller Rite Aid continues to struggle with underperforming stores and a leveraged capital structure. We see CVS and Walgreens well positioned with solid B-level credit ratings, reflecting their larger scale, strong profit margin, stable capital structure, and robust cash flows, while Rite Aid we recently downgraded to an E2, and they've got limited liquidity looking forward, and certainly 2023 is going to be a very challenging year for them. Shifting to grocery, Taylor, I think we have you picking that one up.
Yeah, thanks, Mike. So groceries had an incredibly strong run the last couple of years, could easily pick groceries performance with any retail category. In 2022, continued that trend as the top line expanded and margins held. In 2020-2021, we saw unit growth. In 22, that pivoted. First, we saw units flat, but packaging changing as consumers shop for value. So the example would be like family-sized cereals or a 3-pack of peppers versus a single pepper. But in the back half of the year, we've pretty consistently seen some unit erosion in the low single digits, but sales still advancing due to inflation. And really almost all the sales gains are comp gains, as very few grocers except Publix, Amazon Fresh, and a handful of smaller format grocers like Aldi, Sprouts, and Grocery Outlet have added kind of any meaningful store counts. Speaking more to inflation, and Mike hit on this, but inflation in grocery has been very volatile and yet sticky overall at the same time. Meat went up through 2021, riding double-digit, even triple-digit inflation times for almost a year, Now that's back down, but now eggs are $5 a dozen. And what's even more concerning is the center store inflation, because center store is generally much stickier. The reasons for the inflation are self-explanatory, and as Mike hit on earlier, we have the weather factor that's always kind of there in grocery, but now we also have geopolitical challenges. Also, some fairly significant cost of production headwinds coming through in the form of wages that are just hitting grocery stores and ultimately hitting the consumer. Where does this put us? Food at home inflation right now is around 10, 11%, but it's averaged double digits since March of 2022. And really, there's little reason to believe that's going to significantly decrease anytime soon. So kind of bringing this together, though, I think the top line activity in 2022 was somewhat expected. I would say if there's one surprise from my seat, it would be how successful grocers have been at maintaining profitability, especially with these steep inflationary headwinds and the overall consumer pullback. Really, margins were flat from 21 to 22 and still well above pre-pandemic trends. That said, I think profitability has peaked in the near term, and grocers will be much more challenged to maintain the momentum in 23, mainly due to the consumer pullback and grocers' own steady return of promotions to drive foot traffic. This need for value in grocery will also help propel low-cost options like the Aldis of the world, which we see as a winner. Similarly, in 23, we expect grocers to put increased focus on private label, which has a lower price point to the consumer while also generally a favorable P&L for the retailer. The one big wild card for 23 is the Kroger-Albertsons merger. I don't want to go too deep into this, but this would be the #1 pure play grocer acquiring the #2. Would it help Kroger and Albertsons? Yes, absolutely. There's a ton of synergy with e-commerce, back office, mid office, as well as their marketing services. The big challenge is going to be getting by the antitrust concerns, because in many markets, this would greatly reduce competition. Without kind of buying or selling if this goes through, at a minimum, I think for Kroger and Albertsons, and why we have them in question, is they could be distracted or a bit gun shy from making other strategic capital investments, expecting this acquisition is coming. This likely impacts Kroger more than Albertsons and could lead to Kroger slowing its fulfillment center investment. They currently have 6 of these macro fulfillment centers, and has announced at least 2 more to date. But also the entire rest of the field now has a chance to benefit because of the divestitures. We recently acquired MTN Retail Advisors. This team analyzes grocery with a boots on the ground presence. They had been to these markets, they had been in these stores forecasting sales. We've had many conversations and chats with them in the last few months discussing what is going on and what's going to take for this to go through. Albertsons has 200,000, 250 stores, give or take. The merger calls for up to 650 to be spun off before the acquisition falls apart. It's about 30% of Albertsons store base. And that sounds reasonable based on the overlap we've looked at so far. And ultimately, because of the divestitures, we think M&A will remain in focus. Entities like Raley's, which already bought Bosch's in 2021, could be in the market again to pick up more stores in Arizona to help with FTC clearance. And there's going to be a lot of that as it goes market by market across the country. So again, this is a sector that's done well and should do well in 23 based on the recurring, necessary, consumable nature of its product, though probably not quite as well as 20, 21, and 22 as it just cools down a bit.
Okay, so for the restaurant industry, 2022 was another year of growing sales and recovery really from the pandemic. When I say recovery, I mainly refer to the traditional full service category. Many of those in this category finally got over pre-COVID sales levels on a consistent basis this year. I'm talking about companies like Red Robin, BJ's Restaurants. You can contrast that to the QSR and fast casual categories. Many of those restaurants had already gotten over those levels earlier. But overall, the sales growth was driven by menu price increases. As we've gone over this a few times, but commodity and labor inflation have been very high, and restaurants pass those on to customers. The downside, however, to this higher pricing is that traffic has been slowing for much of the year. Customers are cutting back their spending due to inflation, and by 4Q, we're starting to see sequential declines in outside food spending month to month. We are starting to see commodity inflation step down a bit in the second half. Supply chain costs are normalizing. We're cycling some higher increases in the prior year period. But labor inflation is a bit sticky. We're seeing a lot of companies still have to commit to higher wages and benefits to kind of retain their workers in a really competitive market. Starbucks is a good example of that. So going into 2023, restaurants still expect commodity inflation in the high single digits, labor inflation probably around the mid single digits. So price increases are still going to happen, probably not at the same rate as they've been this past year, however. And at the same time, restaurants are still going to have to balance how much they can raise prices with the potential need to be more promotional because there are more customers seeking value. In terms of store expansion, we saw a lot of companies fall short of their plans in 2022. A lot of this was due to construction or supply delays that pushed openings into this year. Noodles & Company is a good example of that. They wanted somewhere around 8% unit growth, but it ended up around 5%. So overall, I would say the restaurant industry has a bunch of question marks in 2023. The margin pressures are going to continue. Traffic could slip further in a potential recession. There are certainly weaker operators that will continue to shed stores. Steak and Shake is one of those likely to do so. But at the same time, there are some positive trends to be seen. The companies that are in a healthier position, like Chipotle, they're planning to accelerate their expansion. Chipotle had a target of around 230 to 250 new stores in 2022, and they're upping that to 250 to 280 this year. At the same time, others are planning to expand through new franchise agreements, like Potbelly, Noodles & Company, and Jack in the Box as well.
Thanks, Alan. So as we turn to mass merch, this is the first sector we discussed today that really shows the impact of the steep pullback in discretionary goods that Mike was referencing earlier. This sector, like most of the rest of retail, had a wake-up call in early 2022. Going back to the question earlier about supply chain, I remember closing out 21 and all the focus on port congestion on the West Coast. There was literally a container ship counter for a number of ships at sea. We saw Walmart, Target, other retailers privateering their own container ships to get product in stores before the holidays. It was a unique challenge. And oh, how they probably wish that they had that same challenge in 2022. Target CEO commented after his first call, 2022, his comments were, while we anticipate a post-stimulus slowdown and we expected the consumer to continue refocusing their spending away from goods and services, we didn't anticipate the magnitude of that shift. That sentiment was renowned in the industry. Walmart said relatively the same thing, as Walmart sat on about $15 billion of excess inventory after its first quarter. These two then started a domino effect of retailers slashing merch pricing and orders to right-size inventory. The reason for the reversal was very straightforward, as supply chains had improved and then consumers' pullback left big ticket items sitting on the shelves, and generally stores were overstocked with discretionary goods. That said, as a sector, overall performance has been okay. Comps up around 4% for the year, but that's very skewed towards those with higher food offerings. Walmart and Sam's up around 9% comp growth for the year. BJ's up around 6%, Costco up 10%. So strong numbers, while Target only up around 3% based on a smaller food offering. You have entries like Big Lots, which is off 13% per year. And the foot traffic trends inside these retailers reiterates this story, as we generally note club operators with their larger food offerings have seen traffic flat to up, while Big Lots is an example, which has a much higher proportion of discretionary items, saw its foot traffic decrease for the year. The bigger story beyond sales, even though, is profit margins, which fell below pre-pandemic levels, primarily as retailers were forced to slash pricing to move inventory despite the inflationary cost pressures. The toy category was a perfect example of this, as demand trailed off from 2020 and 2021 highs, yet retailers were sitting with elevated inventories that reduced prices to move it. Estimates are as a whole that basic toy sales tracked roughly in line with 21 and 22, but profits were steeply lower, and that's likely to continue in 23. Together with the tighter sales and reduced profits, we issued a handful of downgrades across the sector for the year, including with Amazon, Ollie's, and Big Lots, versus very few upgrades. And looking forward to 23, I think it's a lot more of the same. With this murky economic outlook, the consumer is likely to remain skittish and continue to avoid big-ticket items, shifting sales to more consumables and more value. Thus, those with a higher proportion of food and grocery shelves will continue to perform favorably within the sector. Obviously, this is Walmart, but also the club stores that we've noted earlier. Also, dollar stores should have a strong year. They performed well in the last recession, and their bolstering of their food offering over the last decade will only benefit them more in 2023. There are, however, a few names at risk in the sector. Big Lots, which we've talked about a few times, is facing some real challenges and is still sitting on aged inventory, yet sales and margins have yet to kind of retreat or level off. Are retreating and yet to level off. 90 cents only is at risk, and so is Christmas tree shops. Overall, though, Massworks is basically a sector that is in a terrible position, mainly due to its concentration of non-discretionary items.
All right, thanks, Taylor. Looking at department stores, had a very strong 2021 due to pent-up demand coming out of the pandemic. And sales slowed as 2022 progressed. Not only did sales slow, but the supply chain eased up as the year went on, and retailers in the sector found themselves with way too much inventory. So getting into the holiday season, as Mike alluded to earlier, Macy's and Nordstrom's and several others reported somewhat weak holiday sales. On top of that, it was very, very promotional as they sought to get inventory levels back to normal. Good news is inventory overall in the sector seems to be in very good shape heading into Q1, with the exception of Kohl's, which is still struggling with too much inventory. Looking ahead, getting input from our clients and shipping clients also, retailers here in the sector are buying very conservatively for spring, expecting, I think the general consensus from the department store sector is a very weak first half of the year and gradual improvement in the second half, especially as they're going against easier comparisons. There's definitely pressure continuing on consumers due to inflation, and I believe that's going to limit discretionary spending. And one note, one of Macy's investor conferences, they said that credit card payment rates are starting to deteriorate, which I think is a big red flag. The winners in the sector, I think, are going to be TJX and Ross, as off-price does very well in a weak economic environment. And going back to inventory issues, there's a tremendous amount of product availability out there, some really high-end brand names at good prices. So as usual, off-price will do well from this. And that's the one part of the sector which is expanding. All three major off-price retailers are expanding very rapidly and have increased expansion plans over the next few years. Positive side, alluded to it a little bit, retailers have focused on cleaning up their balance sheets and their inventory levels, and for the most part, they've accomplished that. Another trend in this sector is differentiation, which is department store retailers have probably been trying to do for 30 years now. A lot of that is focused on shop in shops. I guess the biggest example is Macy's and Toys R Us. We haven't got a lot of insight into how Toys R Us did. Macy's did comment that toys was a very strong category for the holidays, so that seems to have worked out well for them. We should get more details on their Q4 conference call. Retailers in question in the sector, and it's kind of in order. Macy's is one of those that have really cleaned up their balance sheet, have no near-term debt coming due. But given their very conservative comments they've made about the first half of the year, we've included them in here. Burlington, which is off-price and should be doing better, have admitted they've had a number of self-inflicted wounds on the merchandising side and the inventory side. I expect them to work that out as the year goes on, but that remains to be seen. And Penny's is interesting. Penny's had about 6 consecutive quarters of really pretty strong results coming out of bankruptcy. Third quarter probably underperformed the sector. And there's a question whether, prior to the bankruptcy, people questioned whether Penny's had a niche and we really needed a JC Penney in the retail marketplace. So the question will be, Did they prove that Penny's deserves to be around with those 6 strong quarters, or was it a case of rising tide lifting all boats? So I think this will be a key year for Penny's to prove that that they belong, and we'll keep a close eye on how they perform. On the loser side, which sounds a little harsh, but we have Kohl's, which put emphasis on merchandise categories that really shrunk, and have, as I mentioned earlier, a lot of inventory issues. I mean, they've done some good things. Sephora is there now. They have Amazon returns. They have some branded shops and shops like Land's End. But they are looking for a CEO coming off a lot of pressure from activist investors. There are some things they can do since they own billions in real estate. They recently rejected a chance to do some sale leasebacks, but it's possible they could revisit that if things don't turn around in the first half. And then there's Belk, which has been in survival mode since their 20-hour bankruptcy 2 years ago. And they're in February, they're set to use their last pick option on the debt. So they're going to begin paying cash interest in May. So as the year goes on, liquidity is probably going to be stressed from those cash interest payments. So all in all, summing up the sector, probably going to be a weak first half and looking for a gradual improvement in the second half. Okay, going over to apparel. A lot of the same discussions we had on department stores happened with apparel. It weakened as the year went on. Certain categories did better. Categories that didn't do well during the pandemic, dressy, special occasions, workwear, improved as the pandemic eased. And some of the categories that performed very well, activewear and leisure, underperformed, especially as the year went on. Again, inventory issues here that mostly worked themselves out due to markdowns in Q4. And a kind of a similar outlook to department stores. The first half is expected to be weak. We've heard from vendors that order placements have been light. So looking at some of the winners, Chico's, which is a really nice turnaround story, and mostly improved due to improved merchandising. Lululemon's been a home run for a long time and continues to churn out some really strong numbers. And Buckle was a concern a few years ago, came out pretty strong after the pandemic and has been able to mostly maintain that momentum. The 3 companies in question, JGL, Victoria's Secret, and Express, all had issues pre-pandemic. They've all benefited from the change in consumer preference back to dressing and special occasion, and Victoria's Secret becoming more inclusive as to what they sell, but remains to be seen whether they can sustain the momentum, and if consumers go back to spending the way they did pre-pandemic, they could be under stress. The concerns, the losers here, Stitch Fix, which is a subscription model, which does not do well in a down economic environment. Also, they spent a lot of money to acquire customers, and over the last few quarters have actually been losing the amount of customers. They're kind of transitioning to being a normal online retailer, but there's not many apparel retailers that make money strictly online. It's mostly omnichannel retailers that also have a brick and mortar presence. So they had a strong balance sheet going in, but there's been some concern. And Land's End had some supply chain issues which impacted sales. Still working through that. Interestingly, part of their solution here is expanding their brick and mortar presence. They've had some brick and mortar stores. They kind of stopped expanding on that pre-pandemic, and looks like that's kind of their growth vehicle for the next few years. So they had cleaned up their balance sheet somewhat during a couple of years where they had some strong earnings. I don't think it's an immediate concern, but definitely something to look at. And then a private retailer, Route 21, refinanced their debt somewhat at the end of the year, but still a concern and something to look at as we head into 2023. So kind of the same outlook as department stores, a weak first half, improvement as we go on into the year. I'm going to turn it over to Alan right now to go over footwear.
Thanks, Jim. So the footwear industry, they spent much of 2022 working through supply chain issues and building up their inventories. You know, product availability was a big issue in 2021 for a lot of the year, especially in the holiday season. And the good news is that the retailers were pretty successful at it. You know, availability really wasn't an issue this past holiday season. The bad news is that retailers are a bit over-inventoried now. Kind of a bad timing, you know, because consumers are pulling back their discretionary spending. As you might expect, this has made the industry more promotional. We're seeing a lot of companies kind of return to that level of promotion that maybe they didn't want to so soon. The benefit of having product availability issues in previous years was that they could sell a lot of products at full price. That's not the case as much anymore. Now we're seeing companies like designer brands rebuild their clearance business. They're trying to attract that value-seeking customer. And obviously this has pushed margins down quite a bit. That trend is probably going to continue this year as retailers work to reduce their inventories to more normalized levels. We've heard from a few of these companies there. They've said that demand is still there, but there has to be like a reason for that demand. So the back-to-school shopping season was good. The holiday shopping season was good, but that in-between period, demand kind of fell off a cliff, so to speak. Store expansion is pretty varied in the industry. You have some of the stronger operators like Boot Barns. They're still committed to double-digit unit expansion. Shoe and Carnival also still wants to expand, though they've kind of pulled back their targets a little bit. They're kind of trying to rely on their shoe station acquisition. And on the other hand, you have some larger chains like Designer Brands and Caleres with Famous Footwear. They're trimming down their store fleet, kind of getting rid of the chaff, anywhere from like 2 to 3% year over year. One thing I want to note here is that online sales are generally falling across the industry. Brick and mortar appeal is pretty resilient. And we're also seeing retailers like Foot Locker kind of try to move trying to re-emphasize the brick and mortar. They're trying to move out of mall locations into more standalone locations. They're trying to emphasize different concepts like bigger square footage stores, like their community and power format, over the traditional format. Next, I believe we have sporting goods.
Yeah, let me. So it's 3 o'clock. For those that can't stick around, we will be sending out these slides after the call today. Also, our contact information is at the back. If there's any questions, any thoughts on the presentation, I'd love to hear from you. And I'm going to turn back over to Mike.
Thanks, Taylor. Yeah, so sporting goods, arguably one of the strongest top line and profit gains during the pandemic. Sales are starting to retrench, and we do expect them to fall further in 2023. So the ability to maintain at least a portion of the outside margin growth will be the biggest differentiator between the winners and losers in 2023 and beyond. Like department stores and apparel, we saw a lot of excess inventory coming into the fourth quarter. A lot of that is starting to get wound down, liquidated during the fourth quarter period. Less ordering for inventory going forward is expected as well. That's been a particular issue for a high concentration of apparel and footwear categories. The other big concern we have going forward is more retailers are starting to expand their stores, especially some of the previous questionable companies like Sportsman and Academy have both launched more aggressive store expansion plans. And that's difficult to do, obviously, in a weak economy when your sales aren't keeping pace with those additional costs that you're inheriting as you expand and invest in the larger store base. The other trends we continue to see is more manufacturers selling direct to consumer channel, whether it's online or through their own retail store base, and pairing their retail customers, the major manufacturers, doing business with a smaller, narrower niche of retail partners. So to maintain top line sales, sporting and retailers need to provide a good point of differentiation to effectively compete against a lot of the big box and online competition, which are increasingly growing their share, particularly of commodity or non-differentiated products. So the winners we have are companies like Dick's, Bass Pro, and PGA Tour Superstores, which offer differentiated and exclusive products, superior customer service, and an overall exceptional store experience. So these are the ones that are able to better compete. Given the growing economic pressures, a deep selection of private label merchandise, it also can offer, offering consumers at lower priced options. That'll help them preserve some of their margins, as private label margins are significantly higher than national brand products. On the other hand, those retailers with high concentration of apparel and footwear will face even more promotional pressures. And that's a risk, especially for companies like Hibbett and Big Five as they enter 2023, particularly with those elevated inventory levels that they've been dealing with. So, that kind of in a nutshell is where we're at. You need that strong point of differentiation. Those pre-pandemic risks that existed are now coming back again. And demand for a lot of these goods, particularly a lot of the outdoor goods, is starting to wane off. One of the biggest categories that we did see growth in was golf. We are seeing golf sales starting to retreat, but we saw a record number of new players during the pandemic, and many of these players are sticking with the game. So companies like PGA Tour and Dick's, that has been expanding its golf selection, has been real strong. On the other hand, hunting and ammo, that was a huge surge in demand during the pandemic. Those sales are very cyclical, and we're starting to see those trail off. So that's going to be tough for companies like Sportsman and even Academy that sell a lot of hunting and ammo goods. With that, we'll move on to housewares and home furnishing.
Thanks, Mike. I'm going to kind of cover housewares and arts and crafts together. Very similar experiences. They both had massive performances the end of 20 and through 21. Pent-up demand, focus on the home, stimulus and all that. And then they each had a really, really difficult and challenging 22 because of supply chain, because of excess inventory, kind of like Alan mentioned with footwear, and which coincided with a downturn in spending, which turns into a bit of a deadly combination. Looking at 23 going forward, we do see the supply chain normalizing. So you got a little bit better situation there. Freight costs are way down, closer to normal, where they were up 10 to 15 times what they were last year at one point. But the one thing there is that just because freight and supply chain is normalizing, for a lot of these, it may take another couple of quarters to actually see the benefit because the costs are baked into the inventory. So you may not see that improvement for gross margin until the second half of 23. And then they're also still facing consumer demand being light. I believe retail sales have been down for 4 months in a row. So it's really dependent on consumer spendings at this point. And if it drops off more than we expect, there could be some bigger troubles for some of these players. On the high end, big luxury has done well. Williams-Sonoma and RH, there's been some pressure. They've brought down expectations a couple times, guidance. But I think maybe it shows that they hit their peak. They're still well above where they were a couple of years ago, but you're starting to see a little pressure on the high end. On the low end, we'll look at the losers first. Let's break some news here. Bed Bath & Beyond is not doing well. In all seriousness, I think Mike mentioned before, we're expecting them to probably file by the end of this week. We have them at F2. They probably should have filed weeks ago. They really probably should have filed in August. They never benefited in 2021 when the rest of the segment was flying up. I think essentially they changed their product lines too much and too quickly. They confused the customer and lost them. Couldn't really bring them back. And we've had 3 atrocious quarters from them with comps of negative 25% plus. So essentially they had no momentum, really no plan to base a restructuring off of. How do you go to bankruptcy and say, all right, we're going to rebuild, but all they do is keep closing stores. So, the latest seems like they've really waited too long. 2 years ago, they closed over 200 stores, Bed Bath stores. In August, they announced another 150. A couple of days ago, they announced another 87. So they closed almost half the chain in the last few years. And results are still terribly poor. So Overall, the Harmon stores are all closing, so that chain seems to be gone. And the Buy Buy Baby they've had on the market, but I don't think it's near the valuation they thought they were going to get for it. So eventually, someone I think would buy them. These store closures will probably headline our store openings and closing piece that we do in May, which will highlight all the significant announced closures for the year, as well as a lot of expected openings going forward from retailers. You just get a feel of who's opening and closing. Looking at another loser in the segment, Tuesday Morning, is another player who went bankrupt just 2 years ago. They restructured, they came out, they closed half the chain, and the performance is no better. So they're still bleeding cash. You had a change of ownership. It's really a distressed exchange. Some investors came in and bought some convertible debt, converted to equity almost right immediately. And I think it was an easy path to acquiring the intellectual property. It is another one where I don't see, even bringing in Pier 1 into the stores is what they're saying. I don't see how that's going to make an impact. Tuesday Morning, we have rated F2 as well, and I don't think they're lasting very long. And in question, and these are big question marks, Kirkland and At Home. Kirkland's had a really tough 22 to the point where liquidity became pretty questionable. Third quarter, they rebounded a bit, so there's a little bit more optimism showing. And then 4Q, suddenly they had another decline in comps, I think about 10%. So a little bit on shaky ground. They improved a bit, at least with 3Q. And At Home's another one that really did well. They actually turned their great performance into being bought out and going private. And with that comes a lot more debt. And I think they were doing okay if you expect performance to continue at previous levels, which is probably almost impossible. So now you have a company that is more leveraged and facing performance issues. So I think both of these should be good for the rest of the year, but definitely could be question marks by the end of the year. And depending on what we see from consumer demand there. Sliding over to the arts and crafts. Party City, they've had various issues with the consumer over the last couple of years. Demand about, with COVID, people not celebrating and getting together, gatherings. And, they've had for several years, and even before that, even before COVID, they're having problems and they were sliding a bit. But I think the biggest issue here was the debt load that they amassed over the years with different acquisitions. And they had, 1.7 billion in debt. So they filed in the last week or so, and they're looking to see what they could do to retool, maybe close a few stores. Moving to Joann, the other loser in this group. I think those charts I mentioned earlier, looking at the 6-year trend, Joann was really struggling pre-COVID. In fact, they were already filed then in early 20, and then COVID hit, and then suddenly they had this burst of demand on people looking for crafts and masks especially. And somehow after 3 really strong quarters, they parlayed that into an IPO. They didn't raise much cash, but they did raise a lot of cash in performance over those 3 quarters. And all of a sudden they were looking a little better, but they expected to keep, or at least their outward comments were they expected to keep that performance and keep it going. But now they've kind of fallen back to where they were before, and they have a consumer that's starting to crimp their spending, et cetera. And Joann is an E2, and they could definitely have issues this year. More likely again toward the back of the year, but it kind of depends on what we see from consumer spending. Michaels is another one. I think they've had very similar overall trends to Joann. Again, just like At Home, they did so well, they got acquired. And what that did is they brought debt from 2.5 to over $4 billion. Now, 22 turned sour. Performance all of a sudden isn't covering all that debt, and debt has grown even further, $4.4 billion. They've always done better than Joann performance-wise. I think they would definitely last longer. I think Apollo is behind it. They would support it for a while. And the maturities go out to 28, 29, so I don't see any immediate term issues there. So I think Joann would be the one that would go first, if anything. That's my comments on arts and crafts. And then I think we're over by quite a bit. I don't think we'll go into too much here, but some of these specialty categories we popped in here, which, I think the movie theaters and gyms are both still trying to recover and get back to pre-COVID levels. Are still a bit shy there, but at least still showing improvements to this point. Furniture, mattress, a little bit like, and home improvement, a little bit like the home furnishing segment to some extent. I guess we're also going to leave time for any questions. And if we can't get to some, we could always follow up personally.
Al, there was one question about, given the bankruptcies and the increase in defaults in 2023, are the likes of Restore and Hilco to be a trend going forward?
Well, it certainly appears that way. I know we've seen it with Belk and Christmas tree shops and Bed Bath and Beyond, and we're still trying to understand all the exact details of that deal. It does seem like it would be more of a short-term plan, where as long as the counterparty risk is acceptable, maybe give vendors some clarity and some support in shipping short-term. But I think it's a means to an end. So either they need it because the retailer is looking to get proper financing to move forward, or it's temporary until they actually end up going into a bankruptcy. At least that's what we're seeing at the moment. I would also say Hilco is in there, and one of their talents is being liquidators. So they're watching the assets closely, so they're able to go in there and monitor their exposure and limit any losses. Did you see any other questions, Mike? Or
Yeah, there was one more question on Saks, Hudson Bay Company. So Hudson Bay Company is the holding company, and you've got the brick and mortar part of Hudson Bay, which includes the Saks off Fifth, and the Canadian Hudson Bay banners. So those are the brick and mortar stores. Those are covered under HBCX. Okay, and then in 2021, the company split off the .com, the e-commerce parts of Saks, Saks.com, and the Saks off Fifth businesses. Currently, the Bay.com, the e-commerce for the Canadian retail brick and mortar business, is still under the Hudson Bay, but that could at some point be separated as well. So that's kind of the organizational structure right now. So in our coverage, we have HBCX, we have Saks.com, and the Saks off Fifth e-commerce business that we're all managing as separate credit risks.
Mike, I think Hudson Bay splitting off the internet business is off the table because the other two really kind of underperformed and didn't live up to expectations. So I think that's not going to happen now.
Right. I don't see any other questions at this time, but if anybody does, all our information is here. We'd love to hear from you. Any comments or questions, please feel free to give us any feedback as well on today's call. And as Al mentioned, or Taylor mentioned previously, we'll have a recorded version of this up on our website by the end of this week. And I want to thank everybody again, and that ends today's webinar.